welcome back to my channel. So today's video is all about candlesticks and chart patterns and how they relate to essentially learning how to read the charts. Now, first thing I'm going to do is kind of break down how candlesticks function, then I'll jump into the patterns and show you how they relate to understanding full context, and then of course we'll break down the time periods, and then of course how they're commonly used. Now first I want to break down what candlesticks are because we see them on the charts. But if you're new to trading, it may be a bit confusing on understanding how they function. So candlesticks represent the price movements over a specific time frame. And this just shows the open, the close, the high, and the low of the price. Now this helps to analyze any type of market trends or potential price reversals. And then of course candlesticks, they form by the way the price moves, and they're commonly used in trading to visualize that market behavior. Now, to break down how candlesticks function, it's important to understand that these are based on particular time intervals. It could be the 1 minute, 1 hour, 1 day, any type of time frame you use. And of course, this is going to tell us the different components of a candlestick. So one is going to be the open, and this is the price at which the security or asset trades upon the opening of the candlestick for that particular time period. The close is going to be the exact opposite. This is the price at which it closes before the candlestick ends that particular time period. And then the high is going to be the highest price reached during that particular time. And then the low is the lowest it reaches during that time. The body is going to be the rectangular part of the candlestick. And this shows the range between the open and the closed prices. Now the wicks are also known as the shadows. These are the extended lines above and below the body. And this just shows the range between the high and the low prices. So I want to start by going over the bearish candle as an example, and you can see I have an illustration here on the screen. Now it shows the $100, $98, $95, and $93 for this specific candle. Now at the $100 mark, that is going to be the highest price for the time frame. So you can see the wick at that high is going to be $100. Then we see the $98. This is where the price opened for the specific time frame. So whether that's the 2 minute, 5 minute, whatever it is. Then we go down to the 95. You can see $95 is going to be where the price closed for the time frame. And then last but not least, the end of the wick, that $93, that's the lowest price for the time frame. Now, on the other hand, the bullish candlestick functions in the same way, but the different direction. So we see the $100, $98, the $95, and $93, same thing. However, at the top, we see the $100 is going to be the highest price for the time frame. The $98 is actually going to be where the price closed for the time frame, since this is a bullish candle. And then if we see the body of the candle go all the way down to $95, that's actually where the price opened for this specific time session. And then lastly, that $93 mark, that's going to tell us the lowest price for the time frame. Now, in regards to interpreting the candlesticks, I definitely want to talk about the bullish patterns, the bearish patterns, and then of course the continuations. So when we look at bullish patterns, you want to know one thing, specifically that the upward price movement is going to indicate the such bullish engulfing that you may see. Now, a bearish pattern, on the other hand, is going to potentially be the downward price movement. And this is going to also indicate that there could be a bearish engulfing or a shooting star pattern that you may see. Now, with continuations, this just suggests that the current trend will continue. So this can be like a flag or a pennant. Now, I've talked about those two in previous videos. I'll leave them linked down below. But essentially, these are going to be how you would interpret the candlesticks. And this just helps you make informed decisions, of course, based on your historical price analysis and then further confirmation for your technical analysis. So now with that being said, I definitely want to discuss the candlestick patterns as single and multiple. And in just a second, I'll show you an illustration of what this breakdown looks like. But to start, we're going to take a look at the single candlestick patterns. And these are formed by a single stick, and it can be like a doji. And if you're unsure what a doji is, it's basically where the candle, it has an open and closed price that's very close or exactly the same, or a shooting star. And each of these pretty much tells the buyers or sellers that these different potential market conditions can signal a reversal. Now with multiple candlestick patterns, they're formed by two or more. And of course, we can have engulfing patterns as mentioned. And again, I'll show y'all in just a second. And this happens when a small candlestick is followed by a larger one that engulfs. And this can also be a Harami pattern where a small candlestick is contained within the body of the previous one. And then of course these patterns can signal the potential trends or reversals. So we'll take a look at that in detail now. Okay, so next up, I want to discuss the candlestick patterns in detail. So I'm going to take it step by step with each of these patterns that you see here on the screen. So first of all, I want to make sure we understand the bullish and the bearish engulfing. And then of course, I'm going to talk about the shooting star, the bullish Harami, and then the different elements that come into play within these. Now, some people trade these patterns specifically just for the objective of whatever it is that they have for that strategy. And again, I tie it all together in a future video, but I just want to provide the basic information for now. So we're going to start at the bottom left hand. You guys see it says the shooting star. And this candle is a pattern for the formation that signals a potential reversal in an uptrend. So this shooting star is going to form when the price opens and then it rises significantly during the session, but then it closes near or below the opening price. So this leaves an upper wick and a little to no lower wick. And here's what makes it unique. The appearance of the candle, it has a small real body at the lower end of its range, but with a long upper shadow at least twice the length of the body. So you can see the wick at the top is at least twice the length of the body. Now this suggests that buyers pushed the price higher, but sellers took control and drove the price back down before the close. So typically this occurs after like a sustained uptrend or a rally with any type of consolidation. So you would know this pattern that it suggests the bullish momentum is weakening and a bearish reversal could be on the way, especially if it's continued by the next candle. So in trading the shooting star, this particular pattern signals that caution that buyers can, and it can be used as an entry point for short positions if you confirm it with additional bearish indicators, and then of course other forms of confirmation. Now the bullish Harami is a 2-candle reversal pattern, and this appears during a downtrend, and this signals a potential shift towards bullish momentum. So pretty much how it works is the first candle is a large bearish candle, and it's followed by a smaller bullish candle that is fully contained within the body of the first one. So you can see that here on the screen. So the second candle opens and closes within the range of the first. And again, it occurs in a downtrend where the pressure for the larger bearish candle is representing selling pressure. And at the smaller bullish candle, it shows a loss of momentum from sellers. And this just signals that buyers are beginning to step in. Now, the bullish Harami suggests that the selling pressure is weakening and a reversal is soon to follow. However, traders typically wait for further confirmation. Always wait for those second and third levels of confirmation. So this can be like a bullish candle following the Harami, and this can increase the confidence that the trend is going to actually reverse. So practical use for this, it can be a good signal for traders, especially if you're entering long positions, if other indicators support the reversal. So a bearish engulfing is of course a 2-candlestick pattern as well, and this indicates a potential reversal from an uptrend to a downtrend. And essentially how it works is it forms when a small bullish candle is followed by a large bearish candle that completely engulfs the body of the first candle. And this just means the second candle opens above or at the close of the first, and it closes below its open. So it's consuming the entirety of the candle. Now this appears at the top of an uptrend or during a temporary rally in a downtrend. Now the larger candle shows that the sellers have taken control and they're overpowering the buying momentum. So this pattern signals a shift in the sentiment from bullish to bearish, suggesting that the previous upward momentum is likely losing that power and that the downtrend could be the next move. Now the confirmation with additional bearish signals such as high volume or a break of support levels, this just strengthens the pattern's reliability. So only use these patterns, especially for the bearish engulfing, as a sign to consider entering short positions or locking in profits on long positions if the trend shows further signs of a reversal. You don't want to just enter it just because you have 1 or 2 signals. You want to definitely make sure you have 3 levels of confirmation. Now with the bullish engulfing pattern, this shows a reversal pattern that signals a potential shift from a downtrend to an uptrend. And the pattern is consistent of a smaller bearish candle followed by a larger bullish candle that completely engulfs the body of the first candle. So the bullish candle opens below or at the close of the bearish one, and it closes above its open, fully covering the first candle. Now, this occurs at the bottom of a downtrend or after a series of declining candles. The first bearish candle shows that sellers are in control, and then of course the second larger bullish candle, it indicates that buyers have stepped in with a stronger momentum. So the bullish engulfing pattern suggests that selling pressure has been overwhelmed by buyers. Now this indicates a potential reversal to the uptrend, and traders often look for further confirmation, such as increased volume or a follow-up of a bullish candle before entering into a long position. And this pattern can be used as a signal to start or add a long position, especially when combined with other indicators. So you have to support the likelihood that this trend will actually reverse. So yeah, y'all let me know if this breakdown helps at all when you're reading the charts. And if so, I can continue to make videos about chart patterns and candlesticks. And with that, that'll pretty much do it for this video. If you found the information to be helpful, feel free to leave a comment down below. I thank y'all so much for watching, and I'll see you in my next one.